Welcome back to CMA USA Exam Coach. In the last few episodes, we covered the major financial statements: balance sheet, income statement, and comprehensive income. Today, we're moving to the next important statement, the statement of equity. Equity is basically the owner's share in the company. Think of it as the portion of the business that truly belongs to the owners after paying off all liabilities. The statement of equity shows how this owner's share changes during the period, what increased it, what decreased it, and how we reach the final balance. It includes things like retained earnings, share capital, dividends, and movements from OCI. Simple idea. It's a report that explains how the owner's value in the company changed over time. All right, let's dive in.
The statement of changes in stockholders' equity is like a detailed report card that shows how the owner's value in the company changed throughout the year. Remember, equity belongs to the owners, so this statement helps us see what increased their share and what reduced it. Equity isn't just one number, it's made up of several different accounts, such as common stock/share capital, the money owners invested, retained earnings, profits the company kept instead of paying out as dividends, accumulated other comprehensive income, AOCI, items like currency translation, gains, losses, unrealized gains on securities, etc. Treasury stock, shares the company bought back. Each of these accounts carries forward from year to year, so we need a statement that explains how and why each one changed. To make it easy to read, the statement is prepared in a column format, one column for each equity account, one combined column showing the total stockholders' equity. The statement starts with the opening balance, the amounts at the beginning of the year. Then it shows every change that happened during the period, such as net income added to retained earnings, dividends paid reducing retained earnings, new shares issued increasing share capital, share buybacks increasing treasury stock, which reduces total equity, OCI items added to AOCI. After listing all those changes, the statement ends with the closing balance, which ties back to the equity section on the balance sheet. So basically, this statement tells the story of equity: who added money, how much profit stayed in the business, what gains or losses went directly to AOCI, and what was paid out or taken out. It shows the full journey from beginning equity to ending equity, step by step. Stockholders' equity is simply the owner's share of the company. It's made up of several accounts, and each one tells a different story about how the company is funded and how it has performed over time. Let's break down each component clearly. 1. Common stock/share capital. This represents the basic ownership of the company. When the company first issues shares and people buy them, that amount goes into common stock. Think of it as the starting investment the owners put in to get the business running. 2. Additional paid-in capital, APIC. If investors pay more than the face value, par value, of the shares, the extra amount goes into APIC. It shows how much confidence investors had. They were willing to pay more than the minimum to own a piece of the company. 3. Retained earnings. Retained earnings is the company's accumulated profit over the years that has been kept inside the business instead of paying out as dividends. If the company earns profit, retained earnings increase. If the company pays dividends, retained earnings decrease. If the company makes a loss, retained earnings decrease. If retained earnings become negative, we call it accumulated losses or deficit. This means the company has lost more money than it has ever earned, a sign of financial trouble. But it doesn't always mean bankruptcy. Some companies take time to turn profitable. 4. Treasury stock. Treasury stock refers to shares the company buys back from the market. These shares are no longer considered outstanding, and buying them back reduces equity because the company spends its own money to repurchase them. Why do companies buy back shares? There are several reasons. To increase earnings per share, because fewer shares remain. To return value to shareholders when the company has excess cash. To prevent hostile takeovers, reduce shares available in the market. To reissue shares later to employees as part of compensation plans. To signal confidence. Companies often buy back shares when they believe their stock is undervalued. Treasury stock always reduces total stockholders' equity. 5. Accumulated Other Comprehensive Income. AOCI. AOCI holds items that do not go through the income statement because they are not part of normal day-to-day business operations. Examples include foreign currency translation adjustments, unrealized gains/losses on certain investments, certain pension plan adjustments. These gains or losses sit in AOCI until they become realized. It's like a special bucket for items that affect equity, but not the income statement. Together, all these components show how much owners invested, how much profit the company has kept, how much it spent to buy back its own shares, and gains or losses that have not yet gone through net income. All right, students, let's take a look at the sample statement of changes in stockholders' equity you see on the screen. At first glance, it may look a little long and technical, but once you understand what each column represents, the whole thing becomes very easy to follow. Think of this statement as a detailed story showing how the owner's value in the company changed from one year to the next. We begin with the balances at the end of 2021. These are the starting amounts for preferred stock, common stock, additional paid-in capital, retained earnings, and accumulated other comprehensive income. As the next year begins, different activities happen inside the company, and each activity increases or decreases equity in a specific way. For example, when the company earns profit, that profit increases retained earnings. You can see that clearly in both years. In 2022, the company earned $3,689, and in 2023, it earned $2,125. Profit always strengthens the equity section because it means the business performed well. On the other hand, when the company pays dividends to shareholders, that reduces retained earnings. Dividends are basically the company sharing its profits with owners. In the statement, you'll notice preferred dividends of $5 each year and common dividends of $1,023 in 2022 and $528 in 2023. These payments decrease the amount the company keeps, so retained earnings go down. Another important item you'll notice is the issuance of common stock. This happens when the company sells new shares to raise money. When shares are issued, common stock increases by a small amount based on the par value, and additional paid-in capital increases by the extra money investors pay. In 2022, the company raised $280 in total from issuing stock, and in 2023, it raised $225. This strengthens equity because the business receives new capital from investors. You'll also see entries for other comprehensive income. These are special gains or losses that do not go through the income statement. For example, currency translation adjustments or unrealized gains on certain investments. In this example, the company had $325 of other comprehensive income in 2022 and $149 in 2023. These amounts don't affect net income, but they do increase a separate account called Accumulated Other Comprehensive Income. When you add everything together, profits, dividends, share issuances, and other comprehensive income, you reach the ending totals for each year. At the end of 2022, the company's total equity becomes $13,866, and at the end of 2023, it increases again to $15,832. This shows that overall, the company is growing, and the owner's share in the business is becoming more valuable. So the main idea is simple. This statement explains why equity increased or decreased compared to the previous year. Every number tells a small part of the story. Some items add to equity, some reduce it, and some adjust it through other comprehensive income. Once you understand these movements, the entire picture becomes very clear. Let's look into another area of financial statements, and that is the notes to financial statements. Now you might wonder, what exactly are notes? Notes are additional explanations that accompany the main financial statements. They help us understand the numbers better by providing context, details, and the methods used to calculate those numbers. Notes are used to amplify or clarify the items presented in the main statements. For example, The balance sheet may show a number for inventory or equipment, but the notes will explain how that inventory is valued, what depreciation method is being applied to equipment, or if there are any special circumstances affecting those numbers. Essentially, the notes tell the story behind the numbers, making the financial statements more transparent and meaningful. A complete set of financial statements is not just the tables of numbers. To truly understand a company's financial position and the results of its operations, notes are essential. They ensure that anyone reading the statements has a thorough understanding of the company's financial health. The notes also explain the methods and policies used to determine the amounts reported. For instance, if depreciation expense appears on the income statement, the notes will describe whether the company uses straight-line depreciation, declining balance, or another method. If inventories are reported, the notes will explain whether the company uses FIFO, LIFO, or weighted average cost. These details are critical because different methods can significantly affect the reported figures. The first note in a set of financial statements is usually a summary of significant accounting policies. This section describes the key accounting principles and policies the company follows. It might explain how revenues are recognized, how assets are measured, or how liabilities are recorded. By presenting this information first, readers can interpret the rest of the financial statements correctly. Companies are required to present these disclosures either as the first note to the financial statements or in a separate section called Summary of Significant Accounting Policies, which comes before the other notes. This ensures clarity and transparency, so anyone reading the financial statements can understand how the financial information was prepared and what assumptions were made. Now that we understand what notes to the financial statements are, let's look at some specific examples of accounting policy disclosures that companies commonly provide. These examples come from the accounting standard ASC 235, which guides how companies should present their accounting policies. The first example is the basis of consolidation used. This explains which subsidiaries or entities are included in the company's financial statements. For instance, if a parent company owns several subsidiaries, the notes will clarify whether all subsidiaries are fully consolidated or if some are accounted for using equity methods. This helps users understand what parts of the business are actually represented in the statements. Next, we have the depreciation method AS used. Companies must explain how they depreciate their property, plant, and equipment. For example, whether they use straight-line depreciation, which spreads the cost evenly over the asset's useful life, or an accelerated method, which expenses more in the early years. This affects how expenses appear on the income statement and the value of assets on the balance sheet. The notes also include information on amortization of intangibles. Similar to depreciation, amortization is how companies expense intangible assets, like patents, trademarks, or software over time. The notes will explain the method and period over which these costs are recognized. Another common disclosure is inventory pricing. Companies need to clarify how they value their inventories, whether they use FIFO, LIFO, or weighted average cost. This is important because different methods can result in very different inventory values and cost of goods sold, especially when prices are changing. The notes also explain recognition of revenue from contracts with customers. This tells users when and how the company records revenue, based on the rules for performance obligations in contracts. For instance, revenue might be recognized when a product is delivered, a service is performed, or over time as work progresses. Finally, companies may disclose recognition of revenue from leasing operations. This explains how the company accounts for leases, whether as operating leases or finance leases, and how lease income or expense is recognized in the financial statements. By including all these disclosures in the notes, the company ensures that users of the financial statements can fully understand the accounting policies behind the numbers and how those policies affect the reported results. Without these notes, the numbers alone might be misleading or confusing. Let's assume this Excel table is one of the sample notes about PPE in a company's financial statements. The table shows all the key details someone reading the financial statements needs to know about how the company accounts for depreciation. The cost column shows how much the company originally paid for each type of asset. The useful life column tells us over how many years the company expects to use each asset. This is important because it determines how much depreciation is recorded each year. The depreciation method column shows that the company uses the straight line method, which means the cost is spread evenly over the useful life. The annual depreciation column shows the expense that goes on the income statement each year. For example, the building's $800,000 cost divided by 40 years gives $20,000 per year. The accumulated depreciation column shows the total depreciation charged so far. For example, after 3 years, the building has $60,000 in accumulated depreciation. Finally, the net book value column shows the current value of the asset on the balance sheet after subtracting accumulated depreciation. For the building, $800,000 cost minus $60,000. Accumulated depreciation gives $740,000. By presenting this information in a note, the company ensures that anyone looking at the financial statements can understand both the accounting method and the effect on financial results. Without this note, readers would see only the net book value on the balance sheet and wouldn't know how it was calculated or how much has been expensed so far. Let's look at how notes actually appear inside a real financial statement. The slide here shows a sample financial report from an Indian company called Jayaprakash. You'll notice that next to many items in the balance sheet, there are note numbers written. These numbers point you to the detailed explanations in the notes section. For example, on the balance sheet you'll see Note 3 next to Property, Plant, and Equipment, or PPE. That means if you want to understand how the company calculated the PPE amount shown on the balance sheet, you just go to Note 3. Now let's open Note 3 together. Here, you can clearly see the breakdown of PPE. The note starts with the opening balance. That's the value of PPE at the beginning of the year. Then it shows you the additions, which are new purchases made during the year, and any disposals, which are assets the company sold or scrapped. Below that, you'll find the movement in accumulated depreciation. How much depreciation existed at the beginning of the year, how much was added this year, and how much related to assets disposed. Finally, at the bottom, you'll see the net carrying amount. This is simply the cost minus accumulated depreciation. That final net amount is the exact figure that appears in the balance sheet under PPE. So whenever you see a number on the financial statements and wonder, how did they get this? The note number will guide you to the full breakdown. This is how we read the notes, and this is why they are such an important part of understanding financial statements.
Thank you for watching this episode. We hope you now have a clear understanding of statement of equity and notes to financial statements. In our next episode, we will dive into another key financial statement, the cash flow statement. We'll explore how it shows the movement of cash in and out of a business and why it's critical for understanding a company's liquidity and financial health. Stay tuned, stay consistent in your learning, and don't forget to practice with questions to reinforce what you've learned. Practice is what turns understanding into mastery. See you in the next episode.